Hello guys, in today's video we're going to talk about arbitrage. This is going to be a theoretical video. Basically we're going to speak about something called contango, or I'm not really sure what the name is. So let's imagine we have, imagine we have futures, a future contract, okay, and the future contract has a base under it, which would be, I don't know, let's take a coin or a crypto coin, okay, so whatever. So it'll be like coin USDT. Okay, that will be our future contract, and the other pair is just going to be a spot coin. Okay, so what we're going to do is basically we're going to buy the coin, okay, and short the futures contract, and we're going to see how the delta is basically related to whatever happens on the market. Okay, so let's go for it. Let's see. Let's imagine. So first of all, so nobody gets confused, okay, at the top, we got our sellers. Yeah, sellers. So people are offering. And at the bottom, we got our buyers, okay? So bids. Bids here and asks here. So at the top are always people who are ready to sell at a more expensive price, okay? And at the bottom, there are always people that want to buy at a lower price. Okay, so these guys always want to buy cheaper, and these guys always want to sell more expensively. Okay, there we go. So first of all, our aim is to open the same value of the contract. So the value is going to differ, right? So let's imagine here is our bids and asks for the future contract. Okay, and that's different color. I'm going to use a different color. Let's say orange. And orange will be our bids and asks for our spot. Okay, so and this is going to be our entry. And this is going to be our exit, okay? I'm just going to save this, so diagram. Okay, so when we enter and we short, okay, we are going to, because we're selling, okay, so we're going to get this price. Sell, so sell future, okay? And obviously when we are buying, we're going to get the ask price. Buy spot, okay, because these guys are selling. Okay, on the other hand, so this is going to be entry, and this is going to be exit. Okay, so on the other hand, when we close our short contract, okay, we're going to buy it back. So we're going to buy futures. Well, not really buy back, right? And for the long, we're going to sell it to the bidders. Sell spot. Okay, so when we open the same amount of this contract and this, well, coin, okay, is basically our aim is to get them in an equilibrium position, so we don't care which way the market goes. So let's imagine, I don't know, $1,000 contract, okay, on both. So we buy $1,000 worth of USDT for the futures, okay, and $1,000 worth of USDT for the spot. Doesn't really matter how many coins you're going to get or how many contracts you're going to get, as long as this happens simultaneously. So your risk is that it doesn't happen simultaneously. So for example, you enter your futures contract and I don't know, you wait 1 hour and then you enter your spot contract, okay, into the other side. You hedge the future, okay. Well, I mean, in the sense, it's actually you're buying the spot and you're hedging it using a futures contract. Okay, so the risk is that you buy your spot and the spot is going to lose its value. You're gonna lose USDT whilst you're hedging it. So you have to understand that the risk exists in that little time period. Okay, so you have to automate this entry. Okay, and you have to, if it's a big contract size, okay, you have to do it step by step, so incrementally. But that's something else to talk about, not in this video. Okay, so now let's move on. we have something called, and we don't care which way, and this is a laboratory experiment. Obviously, there are, things that are going to go a little bit differently. But let's imagine we opened $1,000 worth of futures, $1,000 worth of spot. That happened instantly, okay? And we have a balanced sort of hedged position, okay? So what's going to happen now is that the market is going to start and it's going to move somewhere, okay? So let's just copy this. So let's imagine the market goes down. So if we bought here, so let's imagine the market goes down. In that case, before it goes down, our aim, right, is to sell. There you go. So at this sort of delta. This is how we want to enter, okay? Because when we enter like this, the delta, let's look at the equilibrium scenario first, right? So if we sell, right, and buy at the same price, so the bid will actually equal the ask here, okay? And then, I don't know, the market can go either way. So the market, let's say it moved up or it moved down, it doesn't really matter, okay? Because you have the same contract size, right? If you then exit at the same buy price and the sell price, okay? So if the bid and asks match again at whatever price higher or at whatever price lower, it doesn't matter. Your P&L is going to be zero, okay? I'm not talking about commissions and other stuff, okay? So if we're not taking fees into account, wherever the market moves, as long as when you exit your positions, your ask here and bid here now. So before on entry, it was obviously bid here and ask here, but on exit, it's going to be ask here and bid here, okay? Because you're going to be selling your spot to the buyers, okay? So once these in line, doesn't matter if the market went up or down. So here, your P&L equals zero, okay? However, our aim, okay, is to obviously get some profit. So let's see what can happen if we enter like this. And let's imagine the market moves down. Okay, so here's our entry price for both instruments. This is it, okay? And let's imagine the market has moved. So this futures, I'm going to use a green candle here because this futures contract has been making money. So it made this much money. It made this much money. At the same time, this spot contract has actually lost the same amount of money. So as you can see, that's why the P&L here is actually zero, okay? Now, we want to exit when it does this. So this delta has to delta plus, or I don't know, plus or minus, depends which side you look at it or how you calculate this delta, okay? So if it's the ask of the futures contract minus the spot, the bid of the spot, the delta is negative, okay? So if you get a negative delta, that means your futures contract has made more money than the spot contract has lost, okay? Because this delta has now become negative, okay? So what does this also mean? So if you were expecting to trade this sort of scenario, so if you want the spot to lose less, so basically you are buying the spot, okay, and you want to hedge it using the futures contract. So in a sense, you're expecting to exit your position when the market goes down. Well, I don't know. Let's talk about that later. But if you enter, okay, when there's also a delta upon entry, okay, so there is a delta here which is positive. So this one, well, if we use the same formula, okay, spot minus, so let's to calculate delta, okay, let's use the formula. Delta is always spot whatever, ask or bid or whatever, spot minus futures, okay? So in this case, spot minus futures, oh, why is it negative? It's positive, actually, I'm so sorry. Let's use that formula. It's all over the place. So in this case, delta is positive. So that's the spot bid minus ask of the futures is going to be a positive negative. Here, spot minus is delta is going to be negative. So in this case, okay, so you see, this is going to be the loss of your spot contract. So that makes your P&L zone becomes here and also here. Okay, so you make double the delta. Okay, which is very interesting. Okay, so this is one situation, and I'm just going to kind of save this like this. Okay, now let's try and see what's going to happen to the other side. Okay, so you must also understand, so if you enter, okay, if delta is either negative, okay, upon entry, or delta is zero, okay, then you'll make a profit here when the delta is positive. Okay, now imagine though, I'm just going to continue with this slide. Okay, so imagine though this, okay, goes here. So here we're making zero, but at the same time, if you get a negative delta, so spot minus future, okay, you're getting the negative delta. So you see this side, okay, is going to take over. You're going to get more loss. Okay, I mean, you're going to get more loss, but if your net delta negative was here, it's going to cover this. This is going to cover. Okay, but at the same time, this goes down here. Okay, becomes bigger than this. Okay, so that you have to understand that. So delta, where was that? There you go. So let's just leave it like that. Okay, so I mean, to the upper side, it's going to be pretty much the same. So let's experiment. Take this, take that. So let's imagine, again, we entered at the same price, and now, so here our best scenario is a delta, is a negative delta and a positive delta upon exit. So in that case, we make money. Let's imagine our spot continues making money. So the market goes up, okay, and there's your equilibrium. Now, let's take another arrow. So who is going to make money in this case? The spot is going to make money. Okay, so the spot will make this much, and the futures will, let's draw it from here, will lose this much. Okay, so in this case, it's best, right, to have a positive delta again. Okay, so spot minus futures, spot minus futures. So if you have a positive delta here, delta plus, you're gonna be making this profit here. Okay, so let's take this and extend it a little bit. Okay, there you go. So you can exit when you make your positive delta. And again, if we enter, and here, if our delta is positive, it's a bad thing for us, because that's gonna make our profit less for the spot. So again, it's best to enter when the delta is negative upon entry. There you go. Because in that case, you also make this money here plus this money here. Okay? So the formula overall is spot minus future. So here we go. Let's finalize. So final formula for arbitraging like this is spot minus futures delta upon entry has to be negative, and spot minus futures delta upon exit has to be positive. Okay, so one more time. When we enter, if we have negative delta, we make this money here. If we have negative delta, we make this money here. So here we make more money on the short of the futures contract. Here we make more money on the spot, okay, of the that contract, right? Now, for the long, for the exit, yeah, we have to understand that the delta has to be positive, spot minus futures, okay? Now, again, to calculate delta, we have to take spot minus futures, right? But entry is basically spot ask minus futures bid equals delta, okay? Exit, this is very important. Exit is spot bid minus futures ask equals delta, okay? Okay, guys, hope this clarifies arbitrage for you. Thank you.